Okay. We have already done what we call internal reconstruction as a topic. Now we want to look at another way of how you can reconstruct a company. Remember, we said there are two ways of reconstructing a company, through what we called internal reconstruction, and now we are doing the second approach of external reconstruction. So let me remind you what we said in the previous class. Now, when you are reconstructing a company through external reconstruction, we said, assuming we are reconstructing a company called A, we said if this company is being reconstructed through external reconstruction, then we said another company, let's call it company B. Company B, we said, will come and buy the business of company A. We said in external reconstruction, another company, this other company we said could either be an existing company, or we said it could be a newly formed company. So you can either form a new company to take over the business of the company that is being reorganized, or another existing company can take over the business of the company that we are reconstructing. Now, we also said when a company is reconstructed through external reconstruction, that company must be liquidated. That means company A will have to liquidate themselves so that they sell their business to company B. So in other words, we said company A, we shall be calling it the selling company, while company B, which is purchasing the business of company A, we said we shall be calling company B the purchasing company. That is in essence what we said is involved when it comes to external reconstruction. That when a company is reconstructed through external reconstruction, then that company must be liquidated. And then they sell their business to another company, which could be either an existing company or it could be a newly formed company. Now, we have said company B, we shall be calling it the purchasing company. Company B, we shall be calling it the purchasing company. Good. Now, let me go through now. Whenever you are given a question of external reconstruction, the examiner will ask you to show the entries in the books of the selling company and also ask you to show the entries in the books of the purchasing company. Listen, this company A is being liquidated. In other words, they will be required to close their books. They'll be required to close their books, while company B, which is purchasing company A, they will be opening their books of accounts. So company A will close their books. In other words, they have to liquidate themselves so that they sell their business to company B. So I want to start by looking at what are the accounting entries in the books of the selling company. What are the accounting entries in the books of the selling company? So let me introduce now that. What are the accounting entries in the books? Don't write yet. The books of the selling company. What are the accounting entries in the books of the selling company? Now, there are several. Let me go through. Company A is selling their business to company B. Or in other words, company B is taking over the business of company A. So what are the accounting entries? Number one, we normally say you close all assets. Don't write. We close all assets taken over. Taken over. In other words, listen, you as company B, you could have told company A, we shall take over your motor vehicle, we shall take over your stocks, we shall take over your furniture, and so on. In other words, you company A, you gave out your assets to company B. So you close all those assets. Listen to this now. You close all those assets taken over at their book values. You close all assets taken over by the purchasing company at their book values. at their book values. That's important. At their book values to an account we shall be calling a realization account. Let me assume we want to open an account called realization somewhere down here. Let me open an account called realization. It's the major account in the books of the selling company. Realization account. Now, we close all assets taken over. The question will tell you which assets of company A were taken over by company B. Maybe motor vehicle, furniture, building, cash, all those assets. You close them. We all know assets are always a debit balance. Therefore, to close them, you credit the asset and you debit realization. That's step number 1, which says close all assets taken over at their book values to the realization account. That's step number 1. Number 2. Number 2 is, again, you as company A, you could have given out some of your liabilities to company B. You could have given out some of your liabilities to company B. So number 2 entry says, with liabilities taken over, again by the purchasing company, you close them again to the realization account. Maybe company B took over your creditors, maybe company B took over your loans, or company B took over your debentures, and so on. So with liabilities taken over, you as company A, you close them to this account we are calling, again, realization account. Again, we know liabilities are always a credit balance. Therefore, to close that credit balance, you will have to debit liability and you credit realization. That is step number 2, that says with liabilities taken over, you debit liabilities and you credit realization, and you credit realization. That's step number 2. Let me go to number 3 now. Now, you as company A, you are selling your business to company B. You as company A, you are selling your business to company B. It is obvious there must be something you are charging company B. What is it that you as company A, you are charging company B? Whatever it is that you are charging them, you as company B, whatever you as company A, you are charging company B to buy you, that's what we normally call the purchase consideration. The purchase consideration. So our step number 3 says, whatever is the purchase consideration, let us assume that you as company A, you are charging B maybe 50 million to buy you. So with that purchase consideration, I'm not saying company B is paying me now 50 million. We are charging them 50 million. They will pay me later, but we agreed that I charge them 50 million. So with that purchase consideration, we shall be debiting the account called the purchasing company, which is B Limited. You debit the purchasing company and you credit realization. That is our step number 3. I want to assume the amount is 50 million. You debit the purchasing company and you credit realization, and you say here B Limited. That is 50 million. Now listen. When I'm debiting this B Limited, I am charging them that 50. B becomes like our data. B becomes like a data to us. In fact, we are charging them, so it's a data to us. By you debiting a data's account, you are charging them. We are charging B 50 million. At a later time, this data will pay me that 50 million. We shall see that later. But as at now, we are only charging them 50 million. In other words, you create a data by the name of the purchasing company. That's our entry number 3. We go to number 4 now. We now go to number 4. Listen, as a company A, we have said whenever a company is reconstructed through external reconstruction, that company must be liquidated. Now listen, whenever a company is liquidated, they may incur some liquidation expenses. they might incur some cost to liquidate themselves, maybe to hire lawyers, accountants, and so on. Those are costs of liquidating yourself as a company. So number 4 now says, with liquidation expenses, whatever are the liquidation expenses, you as company A, listen, if you paid them on your own, those liquidation expenses, if you paid them on your own, of course you will credit bank, and you will debit this account we are calling realization account. You will debit bank, so you will credit bank because you are paying, and you credit and you debit this account. So with the liquidation expenses. Now, listen to this now. There are times when, as much as we have to liquidate ourselves as company A, we may not have the money to liquidate ourselves. But because company B wants to buy us, but the only problem is we don't have money to liquidate ourselves, company B might say they are going to pay for us that liquidation expense. Company B could say they are going to pay for us that liquidation expenses. Meaning, remember, it is your cost as company A. It is your responsibility to liquidate yourself so that you sell your business to company B. But you don't have the necessary amount to liquidate yourself. But because company B wants to buy you, they decide they are going to pay that amount on your behalf. Meaning, listen, meaning that you as company A, you only incurred that expense, but you never paid. You only incurred because it's your cost. You incurred but never paid. So what you do in such a case is that you create a liability now in your books as company A. You create a liability now so that once you receive the money from the company B, you will now pay that liability. So under step number 3, under step number 4, we are also going on to say, if the liquidation expenses is incurred but not paid by you, company A, you incurred but not paid. So you will still debit realization and you will credit an account we shall be calling provision for liquidation expenses. Provision for liquidation expense. In other words, you create a liability to be paid later. You create a liability to be paid later, so that you create your liability in your books by the name of provision for liquidation expenses. Whatever the amount, you debit realization and you credit provision for liquidation. So that once you receive the amount, then you will just debit the liability and credit bank once you pay. Good. That's our entry number 4. Let's go on now. Let's go on. We are through with number 4. That is step number 4. We want to go to step number 5 now. We want to go to step number 5. What is step number 5? For step number 5, I want to go back. For step number 5, I want to go back to step 1. Step 1, I told you, close all assets taken over. Close all assets taken over by the purchasing company at their book values. Now listen. What if there are some assets that you as company A you have, but maybe B does not want to take them over? Maybe you have a furniture, but B doesn't want to take it over, or motor vehicle, but B doesn't want to take it over. What do? Remember, you as company A, you are liquidating yourself. And once a company is liquidated, there should be no accounts pending. So you may decide as company A, because company B does not want to take over our motor vehicle or our furniture, what do? We sell it on our own. We look for somebody to sell to. Okay? That's our step number 5, which says, with assets not taken over by the purchasing company, but sold by the selling company. You, company A, you sell the asset on your own. Could be furniture, could be motor vehicle. Company B does not want to take it over, so you decide to sell it. You decide to sell it. So what do? You will debit bank, obvious. You will credit the asset. Let us assume the asset was a motor vehicle. Let us assume the asset was a motor vehicle here, which could have a book value of, let's say, 2 million. We sold it, let's assume, for 2.5 million. In the books, the book value of 2 million, but we are selling it for 2.5. So you will debit bank and credit this account called motor vehicle by 2.5 million. Listen, we can't leave this account pending. We can't leave this account pending. Remember, we have sold motor vehicle, yet there is a difference. There is a difference of just a minute. Okay, so let's continue. So I was saying you have sold the motor vehicle for 2.5 million, but the book value was 2 million. So we sold it at a gain of 500. That gain, you take it to the realization account. Listen, we are not operating a normal business. Yes, it's true there is a gain on disposal. If we were operating a normal business, I would have taken that 500,000 or 500 to the P&L account as a gain on disposal. But don't forget, we are not running a normal business. We are reconstructing this business. So our operating account becomes the realization account. So whatever is the difference in this account, which in our case here is 500, that will go to the account called realization account. If it's a gain on disposal like now. Alternatively, what if we sold it for not 2.5 million, suppose we sold it for 1.5 million. Then it means we sold it at a loss. If the book value was 2 million and we sold it for 1.5 million, then we sold it at a loss of 500. If it was a normal business, I would have taken that loss on disposal to the P&L account. But now we are saying, take it to the realization account. So this loss on disposal, I would credit the asset, and debit realization. That's our step number 5. That's our step number 5 that says, with any assets not taken over by the purchasing company, but sold by the selling company. You debit the bank because you are selling it, and you credit the asset. Then we're saying with the balance in the asset account being either gain or loss on disposal, you transfer it to the realization account. That's our entry number 5. We go to number 6. Number 6 again, I want to take you back to number 2. Number 2, we have said, close the liabilities. With liabilities taken over, we said you close them to this account called realization. With liabilities taken over, I have to debit liability, I have to credit realization. But what if again company B does not want to take over your creditors, or they don't want to take over your loan? What do? As company A, yet we have to liquidate ourselves. And we have said, whenever a company is liquidated, there should be no balance there should be no account pending. What did you do as company A? You could have decided, as company A that we are going to pay that liability on our own. Maybe it's creditors, maybe it's bank loan, whatever it is. So our step number 6 says, with liabilities not taken over by the purchasing company, but paid by the selling company. You as company A, you decided to pay it on your own. You decided to pay that liability on your own. What should be the double entry? What we are assuming, let us assume it's a creditor. Let us assume these are creditors. You come and open the account of creditors. Let us assume the balance brought down was 2 million. Then the question tells you that these creditors were willing to accept, maybe 1.5 million in full settlement. These creditors were willing to accept 1.5 million in full settlement, or maybe 1.8, whatever it is. We owe them 2 million. But the question says they are willing to accept 1.8 million in full settlement. So you will debit creditors by 1.8 million, and obviously you will credit bank. Listen, again, we owe them nothing. But when you look at this account, it's like we still owe the creditors 200. But we agreed with them. Yes, we owe them 2 million, but they were willing to accept 1.8 million in full settlement. So it means, therefore, they gave us a discount. So there is a discount we are receiving from our creditors amounting to how much? To 200,000. So where do you take it? Listen again. If it was a normal business, I would have taken that discount received, the P&L account, as a gain. But again, we are not running a normal business. We are reconstructing company A. So any gain or loss, you take it to the realization account. With that discount received, you debit the creditors and you credit realization. That's our step number 6. It says, with liabilities not taken over by the purchasing company, but paid by the selling company, you will debit liability, whichever the amount, and you credit bank. Then we are saying, if there is any discount we are receiving from creditors, you will still debit creditors and you credit realization. That's our step number 6. Let me go to number 7 now. Now, when I started, I told you that whenever a company is reconstructed through external reconstruction, that company has to be liquidated. Listen, it has to be liquidated. We all know also that whenever a company is liquidated, all the stakeholders of the company must be paid what is due to them. Whenever a company is liquidated, all the stakeholders of that company must be paid what is due to them. Who are the stakeholders? These are ordinary shareholders, maybe preference shareholders, debenture holders. All of the stakeholders of the company must be paid what is due to them whenever a company is liquidated. Now listen. When you take ordinary shareholders, for example, there are several things that you as a company, you owe to the ordinary shareholders. One of them being their ordinary share capital, share premium. These are part of equity. It still belongs to your shareholders. Maybe revaluation reserve, general reserve. All these are things that belong to the ordinary shareholders. Now listen. We don't pay them all those things through the various accounts. In other words, for what we owe them for their ordinary share capital, we don't pay them through that share capital account. For what we owe the shareholders of their share premium, we don't pay them through the share premium account. For what we owe the ordinary shareholders for their maybe retained profit, whatever it is, we don't pay them through that retained profit account. If it's general reserve, we don't pay them through the account called general reserve. Now, what do? Listen. What we do is we consolidate everything that we owe to the ordinary shareholders into one account. We consolidate everything that we owe to the ordinary shareholders into one account. So that when it comes to the time of payment, I'll now pay them only once, but not in piecemeal. In other words, I don't pay them their ordinary through ordinary. I don't pay them their share premium through share premium. I don't pay them their general reserve through general reserve. No, we consolidate all that into one account. So that when the time comes for payment, I only pay them once. That will be it. Okay, good. So that's what I want to do now under step number 7. So what we do, we want to consolidate. In other words, listen, we want to create a liability account. We want to create a liability account for the ordinary shareholders, where we consolidate everything that we owe to them into that account. So step number 7 says you close or you transfer. Let me put it that way. We transfer the balance. We transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to an account we shall be calling ordinary shareholders members account. You transfer the balance of the ordinary share capital to an account we shall be calling ordinary shareholders members. That ordinary shareholders members account is a liability account. We all know again the ordinary share capital is a credit balance. So to close that ordinary share capital, we shall debit that ordinary share capital and we shall credit this account we are calling ordinary shareholders members account. Some books will call it ordinary shareholders sundries members account. No problem. Okay, but the point is it's a liability account where we want to consolidate everything that we owe the ordinary shareholders into this one account. Then when the time of payment comes, we shall pay them once. Good. So we come and debit ordinary share capital to close it. Remember, share capital is a credit balance. To close it, we debit it, and now we come and credit this account and we say your ordinary share capital. Whatever the amount is, we close it. That's our step number 7. That's our step number 7. Good. We go to number 8. We go to step number 8 now. Listen. Again, for step number 8, listen to this now. I have just said a short while ago that there are several things that we owe to the ordinary shareholders. There are several things that we owe to the ordinary shareholders. One of them being the share capital, like I've said. What else? Reserves. Those are things that also belong to the ordinary shareholders. So our step number 8, our step number 8 says we transfer reserves. Transfer reserves to where? To again to the ordinary shareholders members. The ordinary shareholders members. It's something that we owe the ordinary shareholders. Whichever form of reserve. It could be share premium. It could be general reserve. It could be revaluation reserve. It could be any other reserve. Listen. And 2, whether the reserve is a positive reserve or a negative reserve. It could be possible. Some reserves are negative reserves. Still, they belong to the ordinary shareholders. Let me assume we are transferring something like share premium. Share premium is always a credit balance. It belongs to the ordinary shareholders. So you will debit share premium and you credit the ordinary shareholders members account. Give it to them. It belongs to them. So we come to the ordinary shareholders members and we credit it here. And we come and say a share premium. It belongs to them. So you close that share premium account, you debit that share premium, and you credit ordinary shareholders members. Now listen. Same. If there was general reserve, you will debit general reserve and you credit ordinary shareholders members. If there was a revaluation reserve, debit revaluation reserve, you credit ordinary shareholders members. Now listen again. It is possible that there could be a negative reserve. Not that it's possible. It is always there. Remember, when I started this topic, I said, why are we reconstructing the company? We said companies are being reconstructed because they have been making losses over a long period of time. And therefore, we want to eliminate those losses. Okay? So when you go to the balance sheet of this company, which is company A, you will see a retained loss because it's obvious. That's why we are reconstructing this company, because it has been making losses. The retained losses belong to the ordinary shareholders. Just like if there were positive reserves, they belong to ordinary shareholders. Even negative reserves belong to them. So now that there are negative reserves by the name of retained losses, meaning if you go to the P&L account of that company, you will find that retained loss being a debit balance. Give that loss to the owners of the business. And the owners of the business are the ordinary shareholders. What do? You will credit that P&L account. You will credit that P&L account and you will debit the members. So whatever is the accumulated losses or the retained losses, you will debit the ordinary shareholders members and you credit P&L account. Good. That's our step number what? Number 8, which says transfer reserves. Whether positive reserve, like I've given an example, share premium. I've said you debit share premium, you credit ordinary shareholders members. I've also said if it's a negative reserve, like the retained losses, then how do you close it? You credit P&L account and you debit ordinary shareholders members. Good. That's our step number 8. We go to number 9. Number 9. Now, for number 9, I want to take you back to step number 1 and number 5. For number 9, I want to take you back to step 1 and step 5. Step 1, if you remember, we say close all assets taken over. Close all assets taken over. That was step 1. Step 5, we said with assets not taken over. With assets not taken over, but done what? But sold. Now let me ask you a question. You are a company A. You have an asset which company B decided they are not going to take it over. At the same time, you as company A, you could not get somebody to sell it to. That means under step 5. Company A did not take it over in step 1. You tried looking for somebody to take over the asset or to sell to. You didn't get. Yet, listen, I have said, whenever a company is liquidated, you have to close all the accounts. There should be no account pending. So what do you do with such an asset which is not taken over, not sold? The question is, who takes over the loss of that asset? Because we are liquidating this company. You find assets like goodwill in the balance sheet of company A. Company B does not want to take over goodwill. 2, you can't sell goodwill as an asset. Things like copyrights, trademarks, those are some of assets that company B may have decided they are not going to take over. 2, you as company A, you find you can't sell them to somebody. Like you can't sell goodwill on its own. What do? That's the point. Now, listen. We refer to such assets, we refer to them as fictitious assets. So the question is, who takes over the loss of such assets? It's obvious it is the owners of the business who must take over the loss of such an asset. Who are the owners? Of course, the ordinary shareholders. They are the ones who must bear the loss of that asset or such kind of assets. So our step number 9 says, again, we transfer fictitious assets. We transfer fictitious assets again to the account called ordinary shareholders members. We transfer any fictitious assets to the ordinary shareholders members. Let them take over the loss of that asset. Of course, we know assets are a debit balance. Therefore, to close them, you credit the asset and you debit the ordinary shareholders members. Where is it? Here. You come and debit it here and give them the loss of that asset, whatever is the fictitious assets. I've given examples like goodwill, copyrights, trademarks, whatever example the examiner will give it to you. Good. So that's our step number 9. Now, before I go to number 10, number 11, and so on, because there are about 15 entries, before I go to that, the remaining ones, maybe we could put down something now on what we have already said. But I hope we are together so far. Are we together so far? Somebody to chat and say yes. If we are together so far, somebody to chat and say yes. Are we together so far? You chat and say yes. Are we together so far? Yes. Good. Fine. So let's now continue. Now, before maybe we continue, let's listen to this. Before we continue, let me make some announcements. Before we continue, let me make some announcements. Listen. Some of you are new to this class, and so I would advise you, if you are new or if you are friends who are doing advanced financial reporting, tell your friends that we are offering online classes for advanced financial reporting, just like the one we are doing now. Tell them that we also have online classes for financial reporting of the intermediate level. Tell your friends that we also have online classes for financial management of the intermediate level, and we also have online classes for financial accounting of the foundation level, and the one of ATD1 and ATD2. Those two levels also have financial accounting. So tell your friends that they can join us for online classes for those 4 subjects that we are offering as at now. That is the advanced financial reporting of the intermediate level, financial management of the foundation of the intermediate level, financial accounting of the foundation level, and the one of ATD1 and ATD2. Okay, good. Now, if they cannot be able to join the live class, tell them that they can still buy the pre-recorded videos. They can still buy what we call the pre-recorded videos for the whole syllabus, so that they can watch them at their own free time, at their own pace. If they are not able to join the live class, whatever it is, then they can buy the pre-recorded videos. Also, even if they join the live class and they are missing a class, for example, for whatever reason, they can still watch the video of the class that they missed. Whenever somebody joins a live class and he misses the class for whatever reason, you can still be able to watch the video of the missed class. Okay, good. So tell them if they want, they can reach me on this number 0722 658875 0722 658875. If you are using the country code, if you are using the country code is 254. That will be 722 658875. That's my number if they want to reach me. Good. I think that's all I wanted to say. Oh, no, that's not all. Now, some of you are watching me through YouTube. Please click that subscription button down there. Click that subscription button to subscribe to my YouTube channel. Click that subscription button to subscribe to my YouTube channel, so that whenever we post new videos for promotion into the YouTube, you will be notified whenever we post new videos into the YouTube. So please subscribe if you are watching through YouTube. Down there is that subscription button. Of course, my YouTube channel is called CPA Joseph Njuguna. That's the name of the YouTube channel, CPA Joseph Njuguna. That's how you will call, or that's how we call the YouTube channel. Okay. Then also, for those who are watching through YouTube, I want to believe that by now, at least you have understood something on what we have already said. So you can even click that like button. You can click the like button to like the video that we are watching. If you're watching through the YouTube channel, I want to believe by now, on what we have already discussed up to this time so far, you're able to at least say, I've got something. So maybe you decide, let me like the video. Good. You can click that like button down there if you're watching through the YouTube channel. Okay, good. I think that's all I wanted to say. That's all I wanted to say about our online classes. Those 4 subjects, the ones we are offering, and how you can reach me on 0722 658875. Good. So I think now we can put down the summary notes. We can now put down the summary notes on the topic of external reconstruction. We have not finished the accounting entries yet, but we are saying before we go to finish the rest, we can put down the first 9 ones that we have so far discussed. So have a subheading, so have a topic, have the topic down, call it external reconstruction. External reconstruction. External reconstruction. And then you say this, external reconstruction. Then you say this. This occurs where a company is liquidated. This occurs where a company is liquidated. This occurs where a company is liquidated and they sell their business to another existing or newly formed company. We have said this occurs where a company is liquidated and they sell their business to another existing or newly formed company. Or newly formed company. Then you have another subheading now, entries in the books of the selling company. 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 Let's put them down. Entries in the books of the selling company. Number 1. You say this. Close all assets taken over. Close all assets taken over at their book values. Close all assets taken over at their book values to the realization account. Close all assets taken over at their book values to the realization account. Close all assets taken over at their book values to the realization account. Below that, put down this entry. You debit realization. Debit realization. And you credit assets. Debit realization and you credit assets. That's number 1. Close all assets taken over at their book values to the realization account, meaning you debit realization and you credit assets. You can now go to number 2. Number 2. Number 2, with liabilities taken over. With liabilities taken over by the purchasing company. Number 2, with liabilities taken over by the purchasing company. Debit liabilities, credit realization. Debit liabilities, credit realization. Debit liabilities, credit realization. That's our entry number 2. With liabilities taken over by the purchasing company, we're saying you debit liabilities, you credit realization. Let's go to step 3. Let's go to step 3 now. I hope you are through with step 2. Step 3 says, with the purchase consideration. Number 3, you put it this way, with the purchase consideration, debit purchasing company, Of course, the examiner will give you the name of the purchasing company. Put in bracket data. Remember, we said we are creating a data. You debit the purchasing company and you credit realization. You debit the purchasing company and you credit realization. That's our step number 3. Let's go to number 4 now. Number 4. Number 4, say this. With liquidation expenses. With the liquidation expenses paid for or incurred. With the liquidation expenses paid for or incurred. With liquidation expenses paid for or incurred. You debit realization, credit bank, stroke provision for liquidation expenses. Stroke provision for liquidation expenses. If you paid, you credit bank. If you incurred but never paid, you credit the account we are calling provision for liquidation expenses. That's our entry number 4. Finish, we go to entry number 5. With assets not taken over. With assets not taken over by the purchasing company. With assets not taken over by the purchasing company. With assets not taken over by the purchasing company. With assets not taken over by the purchasing company. But with assets not taken over by the purchasing company. With assets not taken over by the purchasing company, but sold. With assets not taken over by the purchasing company, but sold. Debit bank credit asset. Debit bank credit asset. With assets not taken over by the purchasing company but sold. Debit bank credit assets. Then you write there NB. 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 Say this. With the balance in the asset account. With the balance in the asset account. With the balance in the asset account. The balance in the asset account. with the balance in the asset account being either gain or loss. The balance in the asset account being either gain or loss on disposal, with the balance in the asset account being either gain or loss on disposal, transferred to the realization account. Transferred to the realization account. Transferred to the realization account. That's number 5. Let's go to number 6. That's number 5. Let's go to number 6. Number 6, you say this: with liabilities not taken over. Number 6, with liabilities not taken over by the purchasing company. With liabilities not taken over by the purchasing company, but paid. With liabilities not taken over by the purchasing company, but paid by the selling company. With liabilities not taken over by the purchasing company. With liabilities not taken over by the purchasing company, but paid by the selling company. Debit liabilities, credit bank. Debit liabilities, credit bank. Debit liabilities, credit bank. Then you can write there NB, 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 NB. Say this: with any discount received from creditors, with any discount received from creditors, debit creditors, credit realization. With any discount received from creditors, debit creditors, credit realization. Remember, we said it's a game. Good. That's our step number 6. Finish. We want to go to number 7 now. Finish. We go to number 7. Finish. We go to number 7. Okay. Say this. Number 7. Transfer the balance. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Debit ordinary share capital. Debit ordinary share capital. Credit ordinary shareholders members. Ordinary shareholders members. Ordinary shareholders members. You debit ordinary share capital to close it. That's what we said. Then you credit ordinary shareholders members. And remember, I told you it's a liability. We want to create a liability by crediting that liability. Good. That's number 7. Finish. We go to number 8 now. we are through, let's go to number 8. Transfer reserves. Transfer reserves. Transfer reserves to the ordinary shareholders members. Transfer reserves to the ordinary shareholders members. Transfer reserves to the ordinary shareholders members. Under that, you can say A. Number A, if positive reserve, if positive reserve, if positive reserve, e.g. share premium, if positive reserve, e.g. share premium, debit, share premium, debit share premium, credit ordinary shareholders members, credit ordinary shareholders members. If positive reserve, e.g. share premium, debit share premium, and you credit ordinary shareholders members. Okay? Number B, if negative reserve, if negative reserve, e.g. retained losses, if negative reserve, e.g. retained losses, debit, ordinary shareholders members, debit ordinary shareholders members, debit ordinary shareholders members, credit P&L, credit P&L. Debit ordinary shareholders members, credit P&L. Now go to number 9. Can now go to number 9. Transfer fictitious assets. Transfer fictitious assets. Transfer fictitious assets to the ordinary shareholders members. Transfer fictitious assets to the ordinary shareholders members. Transfer fictitious assets, the ordinary shareholders members. Debit, ordinary shareholders members. Debit ordinary shareholders members. Remember, you are giving them the loss of that asset. Debit ordinary shareholders members. Credit fictitious assets. Credit fictitious assets. Debit ordinary shareholders members. Credit fictitious assets. So far, that's all we have discussed. Let me now continue with number 10 up to number 15 now. Finish if you are through. Okay. I want to believe you are through. We want to go back where we stopped in our discussion so that we continue with the remaining entries in the books of the selling company now. Want to believe you are through? Okay. Let me believe you are through. Let me go back. Now listen. Before I go to number 10, sorry. Listen to this now. I told you this. When a company is liquidated, the stakeholders of the company should be paid what is due to them. The stakeholders should be paid what is due to them. We have not paid them yet. Like, for example, for the ordinary shareholders, I said, you should not open various accounts to owe them ordinary, to owe them share premium, you owe them reserves, so you open different liability accounts for them, for the ordinary, for the share premium, and so on. No. We said you consolidate all those liability amounts that you owe to them into one account, and that account is what we were calling ordinary shareholders members. Listen. Therefore, if you have noted, step number 7, 8 and 9, step 7, 8 and 9, they were all related. Step 7, 8 and 9, they were all related in the sense that it is that we were transferring everything that we owe to the ordinary shareholders into one account. That's the account called ordinary shareholders members. We started by transferring the ordinary share capital in step 7. We gave them their reserves in step 8. Then we told them, now that the company has some fictitious assets, you ordinary shareholders, take the loss of that asset. Good. Number 10. Listen to this now. The ordinary shareholders may not be the only stakeholders in our company. There could be preference shareholders who also must be paid what we owe to them. Good. Now listen again. Which means again, you can't pay everything that you owe to the preference shareholders through the various accounts. You will consolidate again everything that we owe to the preference shareholders into one account. And that account again is called preference shareholders members account. So one thing that we as a company, we owe the preference shareholders for their amount is their share capital. So step number 10 says we transfer the balance, or we can just put it transfer preference share capital, transfer preference share capital to an account we shall be calling preference shareholders members. We shall also open, just like we opened the ordinary shareholders members, we need to open another one called preference shareholders members. So we open an account called preference shareholders members. We have to close preference share capital. It's a credit balance. To close them, you debit that preference share capital and you credit this account. Come and say a preference share capital, whatever it's the amount. Listen to this now. Still, for the preference shareholders, you as a company, you may not have paid them their dividends in arrears for the last 5 years or 3 years, whatever the question will tell you. The question might tell you that preference dividends are 3 years in arrears. Okay? That is still something that you owe to them. Listen to this. We said that when we were discussing the topic of internal reconstruction, you remember, we said that as much as preference dividends in arrears are liability, they don't appear in the balance sheet. You remember we said that when we were discussing the topic of internal reconstruction. We saw that you have to capitalize that liability. You owe the preference shareholders their dividends in arrears. Remember, we are giving it an example, or the name, we were giving them the name contingent liabilities. And we were saying when you are reconstructing a company and you come through across a contingent liability, which we were giving an example like preference dividends in arrears, then we were saying that liability must be crystallized immediately. You remember, I'm just reminding you. In the topic of internal reconstruction, we were capitalizing that contingent liability through an account called capital reduction account. You remember we were opening an account called capital reduction. But now we are not reconstructing this company through internal reconstruction. We are reconstructing this company through external reconstruction. Still, as a company, we have not paid the preference shareholders dividends for the last 2 years. So it's still something that we owe to them. So which means, and I say that when you go to the balance sheet of this company, you will not find a liability called preference dividends in arrears. We know, and we said that in details when we were discussing the internal reconstruction. But when you are reconstructing a company, we said you must crystallize. In other words, make it a liability officially now. And it's the same thing we want to do now. Listen, the only thing is, this time we shall not open an account called capital reduction, but we shall debit with any preference dividends that are still in arrears. We shall debit realization. Remember, that's our operating account. In the topic of internal reconstruction, our operating account was capital reduction. But now we are reconstructing through external reconstruction, our operating account becomes realization. So with any preference dividends that are still in arrears, you will debit realization. With any dividends in arrears, you will debit realization and you will credit the ordinary the preference shareholders members. Remember, you as a company A, you owe the preference shareholders their dividends for the last 2 years, 3 years, and so on. So you will debit realization and you will credit the members here, which means you come and increase what we owe to them for their dividends in arrears, whatever it is. So that's our entry number 10, which says, let me take you back. Number 10 says, transfer the balance of the preference share capital to the preference shareholders members. We have said you debit preference share capital and you credit preference shareholders members. I am going on still under that number 10. We are going on to say NB, don't write, but we are also going on to say if there are any dividends in arrears, that is with any dividends in arrears, because not all questions have dividends in arrears, no. But if there is any dividends in arrears, then you will debit realization and you credit preference shareholders members account, because it's something that we as a company, we owe to our preference shareholders. So we must increase what we owe to them by crediting their account, which we are calling preference shareholders members. Good. That's our step number 10, which says transfer the balance of the preference share capital to the members account by debiting preference share capital and crediting preference shareholders members. Then we are also going on to say if there are any dividends in arrears, debit realization and you credit the members account. Good. Let me now go to number 11. Let me finish the remaining, then we shall put down the summary notes. Number 11, listen, I want to take you back to number 3. I want to take you back to number 3. And I hope you remember number 3 said what? With the purchase consideration. With the purchase consideration. You remember we were assuming that we as company A, we were assuming we are charging company B 50 million. I told you they had not paid us. Are you there? We were only charging them. If you look at this, we debited the purchasing company, whom we are calling B, with this amount of 50 million. And we credited realization here by 50 million. Now listen. A time has come where B has to pay us that 50 million now. A time has come where B now has to pay us, because we were charging them that time. In step 3, we were only creating a data by charging them. Now a time has come for them to pay. Now listen. Company B may decide they are going to pay you this 50 million all in terms of cash. Or they may decide they are going to pay you this 50 million, maybe all of it by giving you their debentures. Or company B may decide they're going to pay you all this 50 million by issuing to you their shares so that you become shareholders in the new company, and that will settle your debt. Alternatively, company B might say part of that 50 million they are going to pay you in terms of cash, or in terms of debentures, and in terms of shares. Let us assume from the question you realize that 10 million of that 50 will be paid in cash, 20 million in terms of that 50 will be paid in terms of debentures, and 20 million in terms of shares. So you as company A, listen, I'm not saying you're the one issuing the shares. I'm not saying you're the one issuing the debentures. You are the one receiving. So these are assets you are receiving, either in form of cash, or in form of shares, or in form of debentures. So our step number 11 now says here, our step number 11 says, with the receipt of the purchase consideration, with the receipt of the purchase consideration, either in form of cash, shares, or debentures. If you are receiving cash, you just debit cash. Let me assume 10 million, you debit cash and you credit the purchasing company. Come and say your cash, 10 million. If you are receiving shares, you debit shares. You are debiting shares. Listen, you are not the company issuing, you are receiving them. So you are receiving shares of company B as an asset. So you debit shares account and you credit the selling or the purchasing company, 20 million. If you are receiving debentures, you will debit debentures. Again, don't forget, I've said you are not issuing the debentures, you are receiving them as an asset. So you will debit debentures by 20 million and you credit the purchasing company by 20 million. Good. That's our step number 11, which says, with the receipt of the purchase consideration, either in form of cash, shares, or debentures, you debit cash, debit shares, debit debentures, and you credit the purchasing company. That way they will have paid their debt. That's our step number 11. With the receipt of the purchase consideration. Good. We go to number 12. Now listen to number 12. You as company A, you charged B 50 million. They have now paid you in cash, shares, and debentures. But at the same time, I told you, whenever a company is liquidated, the stakeholders must be paid what is due to them. One group of stakeholders that we have are the ordinary and the preference in this company. They have to be paid. Now that you have cash, now that you have shares, now that you have some debentures, pay. So our step number 12 now, we want to start paying the stakeholders. But the question is, who do we pay first? Whenever a company is liquidated, do we normally pay the ordinary shareholders first? Or do we normally pay the preference shareholders first? It's obvious, you know, that whenever a company is liquidated, in the order of priority, when it comes to liability payments, preference normally rank first in order of priority. You have done the topic of liquidation of companies, so you know that whenever a company is liquidated, preference shareholders normally rank first. Ordinary are the last people to be paid, but the preference shareholders rank first than ordinary. So listen, step number 12 says now, pay the preference shareholders what is due to them. You pay the preference shareholders. Now listen, the question will tell you, among the things you have received, the cash, the shares, and the debentures, among them, what is it that you are using to pay the preference? It could be you are told to give them the cash. It could be you are told to give them shares. It could be the question tells you to give them the debentures, or partly cash, partly shares, partly debentures, whichever it is. If you are giving them cash, then go pick that cash from where you have it, which is here. You credit the cash and you debit the preference shareholders members. Where did we open it? Here. We had the liability. Now we want to pay it. You come and debit the liability, say cash, whatever it is that you are giving to them. If you are giving them shares, again you credit shares, you debit the preference shareholders members. If you are giving them the debentures that you received as an asset, then you credit debentures because you debited when you are receiving, credit debentures, and you debit the members. Come and say your debentures. Whatever it is that the question will tell you. That's our step number 12. Pay the preference shareholders what is due to them. Pay the preference shareholders what is due, either in form of cash, shares, or debentures. If cash, credit cash. If shares, credit shares. If debentures, you credit debentures, and you debit the preference shareholders members. That's our step number 12. Let me go to number 13. I don't know whether I have enough space up there. No. Let me come down here. Step 13. Will I squeeze step 13? Let me squeeze it here. Now listen. I take you, before I give it to you, look at this account called preference shareholders members. Look at that account called preference shareholders members. Where is it? It's here. On the credit side of this account, that's what you owe to the preference. One thing I owe to them was their share capital, whatever the amount. The other thing I owed to them was the dividends in arrears. Then on the debit side of this account, I have given them cash, I've given them shares, I've given them debentures as a payment. So you will compare the two sides. Let me, for purpose of illustration, assume that suppose the total on the credit side of this account is 2 million for purpose of illustration. But when you add what you have given to them in total, you find it's coming to 1.8 for purpose of illustration. On the credit side, we owe them a total of 2 million or whatever it is. But I can see on the debit in form of payments, we have given them 1.8 as a payment. Which means again, you are either overpaying them or you are underpaying them. For now, we owe them 2 million, but we are paying them 1.8 million. We are paying them less than what we owe to them. That means the 200 balance in this account, to us as a company, that's a gain. Because we are paying the preference shareholders 2 million, we owe them 2 million, but we are paying them 1.8 in full settlement. So we are getting, or we are making a gain of 200. That gain of 200, you take it to the realization account. What if, on the other hand, you realize from the question that on the credit side you owe them 2 million, but when you add all what you have given to them, you find it comes to 2.8 million. A difference of 800. And it's on the credit side. We owed them 2 million, but when I add all the various forms of payments, they're coming to 2.8. That means we are paying them more than we owe to them. That automatically, as a company, to us is a loss. Again, that loss should be transferred to the realization account. That's what we are using as our step number 13 down here, which says, with the balance in the preference shareholders members, with the balance in the preference shareholders members, that balance is either a gain or loss on payment. Initially, I owed them 2 million. I paid them 1.8. We made a gain of 200 on payment. I had to debit the members, which is preference shareholders members. I had to credit realization. The other hand, you realized it could be a loss. I owed them 2 million. I paid them 2.8 million in total. That's a loss. Take it to the realization account. That's what we are saying as our step number 13, which says, with the balance in the realization account, with the balance in the preference shareholders members account being either a gain or loss on payment, you transfer it to the realization account. We have said if it's a gain, you debit the members, credit realization. If it's a loss, you debit realization and you credit the members. Yeah, good. That's our step number 13. Let's go to number 14. Now listen. Number 14, we as a company A, we are selling our business. Could we have sold our business at a gain or loss? We are selling it to company B. So we want to know, are we selling our business at a gain or loss? So to know whether we are selling our business at a gain or loss, you now come to this account called realization account. Remember, we said that is the operating account. We come to this account called realization. Where is it? Here. If you look at this account called realization, on the debit, it shows the assets as a company A I gave out. All those assets. It also shows the expense I incurred as company A. But on the credit side, it shows what I'm going to receive from company B. So there will be a balance in this account. That balance in this account will represent either gain we made on selling our business or a loss we are making on selling our business. If what I'm giving out on the debit is more than what I'm receiving on the credit, I'm receiving 50. If the difference is there and on the credit, it means I'm giving out more than what I'm receiving. So as a company, we are selling our business at a loss. We'll be on the credit side. What if the credit side, which has that 50, is more than what I'm giving out on the debit? Then it means I'm receiving more than what I'm giving out. So as a company, we are selling our business at a gain. It will be on the debit side. Then the question is, who takes over the gain or loss of selling this company? Obvious, it is the owners of the company who must take over the gain or loss on selling of the company. And who are the owners? It's obvious. They are the ordinary shareholders. So if it's a gain, like we have it on the debit side, you will debit realization and you will credit ordinary shareholders members. Give them their gain. If it's a loss like it was on the credit, you will credit the realization and you debit ordinary shareholders members. Let us assume it was a gain. I'm going to debit realization and I'm going to credit ordinary shareholders members, give them their gain. You come and see a realization. Whatever it is. That's our step number 14, which says, with the balance in the realization account being either a gain or loss on realization. Then I've said, if gain, you will debit realization because it is on the debit, being that you are going to receive more. The purchase consideration is more than the assets taken over, given out. So if you are going to receive more than what you gave out, then it's a gain, which is on the debit. You will debit realization, credit ordinary shareholders members. If what you're giving out on the debit is more than what you're going to receive on the credit side, then that is a loss. Give it to the owners of the company. The owners of the company are ordinary shareholders. Good. That's our step number 14, which I've said says, with the balance in the realization account being either a gain or loss on realization, you transfer it to the ordinary shareholders members account. Finally, step 15. I told you, when a company is liquidated, all the stakeholders must be paid what is due to them. So the last person, this was balancing the realization. That was step 14. Now step 15 says, pay the ordinary shareholders. They are the last people to be paid. Pay the ordinary shareholders what is due to them. Remember, as company A, you received cash, you received shares, you received debentures. So again, the question will tell you, what is it that you are giving to the ordinary shareholders? If you are giving them cash as a payment, go to the cash account that you opened, you debited when you are receiving it. Here, you debited this 10 million. Go credit cash and now debit the members account. Where is it? Here, ordinary shareholders members, you come and see your cash. If you are giving them debentures, you received the debentures as an asset. Go where you debited it, here, on the right side, you credit the debentures and you debit the members. And you debit the members. Where is it? Here. Come and say your debentures. If you are giving them shares, you received shares, you debited shares account. Go pick it. Here. You credit the shares and you debit the members. Whatever it is. That's our step number 15 and the last one. If you do that, then you have closed the books of the selling company and now you have liquidated company A. So those are the 15 accounting entries. Those are the 15 accounting entries. Now listen. I want you to listen before we put down the summary notes on what we have said for the remaining other entries. Now listen carefully. I don't want you to cram these entries. I don't want you to cram the entries. But I want you to understand the process. Where did we begin? In the books of the selling company, where did we begin? Number 1, close all assets taken over. Number 2, liabilities taken over. Close them. 3, purchase consideration. 4, liquidation expenses. Listen, what I was doing up there, I was only closing the books. That is step 1, 2. I was closing the books. Closing the assets, closing the liability. Listen. 3, I charged that data. I charged the data, which is the purchasing company. Listen. In most questions from your past papers, I want you to listen. Most questions from your past papers, you will not find step 5 and 6. In most questions, you will not find step 5 and 6. where assets were not taken over but sold. 6, where liabilities were not taken over but paid. Most questions you will not find them. You will not find those two entries. Most of the assets are taken over. Most of the liabilities are paid. Good. Now, listen. So if you look at the upper part of the entries, I was closing the books, then creating a data. Then when I come to number 7, look at the entries. When I came to number 7, 8, and 9, all that I told you, they are related in the sense that we said they belong to the ordinary shareholders. What I was doing in 7, 8, and 9, I was only transferring everything I owe to the ordinary shareholders into one account. Their share capital, their share premium, their general reserve, their fictitious assets. I was transferring everything that I owe to them into one account. Okay, that's what I did in step 7, 8, and 9. All those belonged to ordinary shareholders. Then number 10, I did the same for the preference. I transferred everything that I owe to the preference to one account. Called who? Preference shareholders members. Okay, good. Number 11, I came and received from the preference. No, from the company B, the receipt of the purchase consideration. I received, whether cash, shares, or debentures. Once I received, I started paying. I started by paying who? The preference. Then I have now finished by paying who? The ordinary. So I want you to get the flow of the entries. First, you close the entries or the books, create a data by the name of the purchasing company. Listen. Then create the liabilities for ordinary and preference by consolidating everything you owe to them. Forget about number 5 and 6. That may not be there in questions, but we have just mentioned them in case they are part of the question. But most questions you will not find number 5 and 6. But 7, 8, and 9 will be there. That is consolidating everything you owe to ordinary. Then number 10, consolidate everything you owe to preference. Then receive the purchase consideration. Once you receive, start paying. Start by paying who? The preference. Then you pay the ordinary. That is how we are liquidating this company. So the first entries, like number 1, listen. First entry number 1 and 2 and 3, you should not forget. Number 1, 2, 3, and 4. Closing the assets, closing the liabilities, creating a data. For liquidation expenses, it will be told to you who paid it. Okay? Then we are saying, now you come to, listen, come to consolidate everything that you owe the ordinary. You may not follow ordinary in terms of ordinary share capital, reserve. You can start with any, so long as you consolidate everything that you owe to the ordinary. I'm not asking you to start closing the ordinary share capital first. You could close reserves. You could close fictitious assets first. But the point I'm doing in step 7, 8, and 9 is to consolidate everything that I owe the ordinary. Are you there? Good. Then 10, I did the same for preference. Consolidate everything that you owe to the preference in terms of share capital for them and their preference dividends in arrears. Good. Then 11, receive the purchase consideration, because in step 3, you only created a data. Now receive it. I've told you the question will tell you how the company B is paying that 50 million, either in cash, shares, or debentures, whichever form. Receive them. Debit, whatever you're receiving. Then you credit the purchasing company. Once you receive, start paying. Who do you pay first? The preference. I've told you, the question will tell you what is it that you have received which will be used to pay the preference. Are you giving them cash? Are you giving them the shares? Are you giving them the debentures? The question will tell you what is it that you're giving to them. Okay? Once you pay the preference, come and pay the ordinary. I hope you are getting my clue of what I want you to get here. Because in the books of the selling company, the entries may look too many, but they should not confuse you. What is important is the flow of the entries. First, you close the books. Next, create liabilities. Close the books, create liabilities. Receive from the repurchase consideration. Start paying. Are you getting? Close the books, number 1, 2, 3, and 4. Close the books. Then next, create liabilities, ordinary and preference. Receive, purchase consideration, start paying, ordinary and preference. Good. That is the flow. Maybe what we can do now, let's put down the remaining few entries that were remaining. Let's put down. We had gone up to number what? We had gone up to number 9. So let's go to number 10 now. Let's go to number 10. In terms of notes now. Let's go to number 10 in terms of notes. Say this. 10. Say this. Transfer the balance. Transfer the balance. Transfer the balance of the preference share capital. Transfer the balance of the preference share capital to transfer the balance of the preference share capital to the preference shareholders members. Transfer the balance of the preference share capital to the preference shareholders members. Debit preference share capital. Debit preference share capital, and you credit preference shareholders members. Preference shareholders members. Debit preference share capital, and you credit preference shareholders members. NB note. NB note. NB notes. With preference dividends in arrears. 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 Debit. Realization. Credit preference shareholders members. Debit preference share capital. Debit realization, we have said with any preference dividends in arrears. Debit realization, credit preference shareholders members. Credit preference shareholders members. That's our entry number 10. Finish, we go to number 11. Number 11, you say this. With the receipt of the purchase consideration. By 11, with the receipt of the purchase consideration, with the receipt of the purchase consideration, either in form of cash, shares, or debentures, with the receipt of the purchase consideration, either in form of cash, shares, or debentures, with the receipt of the purchase consideration, either in form of cash, shares, and debentures. You debit cash, stroke shares, stroke debentures. You debit cash, stroke shares, stroke debentures, and you credit purchasing company. In bracket, you can put data. Remember, in our step 3, we debited the data. Now we are receiving, we are crediting the data. You debit cash, or you debit shares if you are receiving shares, or you debit debentures if you are receiving debentures. The question will tell you, and you credit the purchasing company. And you credit the purchasing company. That's our step number 11. Let's go to number 12. Number 12. We are through with number 11. Number 12 says, pay, put it down. Number 12 says, pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them, either in cash, shares, or debentures. Pay the preference shareholders what is due to them, either in cash, shares, or debentures. Pay the preference shareholders what is due to them, either in cash, shares, or debentures. Pay the preference shareholders what is due to them, either in form of cash, shares, or debentures. Debit, preference shareholders members. Debit preference shareholders members. Credit cash, stroke shares, stroke debentures. Debit preference shareholders members. Credit cash, stroke shares, stroke debentures. It's the question that will tell you what is it that you are giving to them. If you are giving them cash, you credit cash. If you are giving them shares, you credit shares. Giving them debentures, you credit debentures. That's our step number 12. Let's go to number 13. Number 13. With the balance. With the balance in the preference shareholders members. With the balance in the preference shareholders members. With the balance in the preference shareholders members being either a gain or loss on payments. With the balance in the preference shareholders members being either a gain or loss on payment, being either a loss or gain on payment. Number A under that. Number A, if gain, debit. If gain, you debit. Preference shareholders members. You debit preference shareholders members. Credit realization. Credit realization. Remember, you are paying them less than you owe to them. So it's a gain to you. Debit preference shareholders members and you credit realization. Number B, if loss, debit realization, credit preference shareholders members. preference shareholders members. If loss, debit realization, credit preference shareholders members. That's our step number 13. Number 13. Want to go to number 14. Number 14, say this. With the balance in the realization account. With the balance in the realization account. With the balance in the realization account. The balance in the realization account being either gain or loss on realization. Being either gain or loss on realization. With the balance in the realization account being either gain or loss on realization. Number A, if gain, A, if gain, debit, realization, credit, ordinary shareholders members. Ordinary shareholders members. Remember, we sold the business at a gain. The owners take it. You give it to the ordinary shareholders members. You debit realization and you credit ordinary shareholders members. That is if it's a gain. Number B, if loss, if loss, you debit ordinary shareholders members. Ordinary shareholders members. You credit realization. Debit ordinary shareholders members. You debit ordinary shareholders members. You credit realization. That's our number 14. Finally, number 15. Finally, number 15. If you are through. Finally, number 15. Pay the ordinary shareholders what is due to them. Pay the ordinary shareholders what is due to them. Pay the ordinary shareholders what is due to them, either in cash, shares, or debentures. Pay the ordinary shareholders what is due to them, either in cash, shares, or debentures. Pay the ordinary shareholders what is due to them, either in cash, shares, or debentures. You debit. Let's put down the entry now. Debit ordinary shareholders members. Don't forget we are paying them a liability now. We debit ordinary shareholders members. And you credit cash, stroke shares, stroke debentures. You received them, now you are using it to pay. So you credit. Okay. We have said number 15, pay the ordinary shareholders what is due to them, either in form of cash, shares, or debentures. You debit ordinary shareholders members, and you credit cash, or you credit shares, or you credit debentures. we have no time to look at the books of the selling company, the purchasing, sorry. That's what we shall do next time. We shall look at entries in the books of the purchasing company. That's what we shall do next time. For the books of the purchasing company, there are not many entries, so they will not confuse us. There are not many. They are normally about 6. But even so, I've said, even in the books of the selling, where they look like there are many, I've told you they should not confuse you. What you should know is the flow. Start by closing the books. Create a data by the name of the purchasing company. Create liabilities in terms of date are ordinary and preference. Receive the purchase consideration. Not paying whoever the stakeholders are. First pay the preference. Lastly pay the ordinary. That is the flow. Okay? Also emphasize and say, normally entry number 5 and 6 may not be part of the question. Most questions don't have scenarios where the company sold their own assets or the company paid their own liabilities. But we have just mentioned the entries just in case a question would have them. So you will allow me to stop there for today. But just as a reminder, that if you want to join us, if you are here and you want to join us for the online classes, just note that we have said you can tell your friends, or if you are one of them, that we are having online classes for advanced financial reporting of the advanced level. We also have financial reporting of the intermediate level. We also offer financial management of the intermediate level. We also have online classes for financial accounting of the foundation level, the one of ATD1 and ATD2. Then we have said, when they join the live class and in case they miss a class, they should not panic. We said they can still watch the video of the class that they missed at their own free time. And I said, somebody cannot be able to join the live class, then they can buy the pre-recorded videos where they can watch the videos at their own free time, at their own pace. Good. And I've said, if you want to reach me, you can call me on that number, 0722 658875. Okay? Then I've said, if you are watching this through YouTube, please click that subscription button down there. Subscribe to my YouTube channel so that you may be notified whenever we post new videos into the YouTube for promotion. I've said the YouTube channel is called CPA Joseph Njuguna. Then I've said, if you are watching through YouTube, and I want to believe you have understood something for today's class, please click that like button. You can even leave a comment. Leave a comment on whether you have understood. Okay? Good. So let me stop there for today. I want to believe that even you who is watching now, at least you have managed to get something. Okay? Somebody can put down a comment as we come to a close. Put down a comment, you chat and see